This is a conversational webinar, something different to what we've done in the past. Alexia is going to walk us through the pillars of ViDA and the key facts that you need to know. Then Matt, our compliance VAT specialist, will bring this all to life with real-world examples and practical context, so you can clearly understand how these changes could impact your business. So with that being said, I'm very excited for the webinar, and I'm sure you all are too. The agenda for today will do pillar 1, which will take us through e-invoicing and digital reporting. Pillar 2 will discuss platform economy, and pillar 3 will be single VAT registration. So today, as I mentioned, I'm going to hand over to Alexia, who's our VAT specialist, Matt, who is our VAT compliance specialist.
Thank you, Daniela, and welcome everyone. Indeed, ViDA has been a hot topic for years now since its announcement back in 2022. ViDA, as you probably know, stands for VAT in the digital age, and it's probably the biggest VAT reform at EU level. It amends our current VAT directive, and it's built around these 3 pillars you can see in the screen. We have pillar 1, e-invoicing and digital reporting requirements. So the amendments within this pillar mainly aim to create a more efficient and digital system for VAT obligations and also tackle VAT fraud, particularly on intra-community transactions. We have pillar 2, platform economy. The amendments here address challenges that we see with the increased online trade, but particularly in 2 specific industry sectors, which are the short-term accommodation rental and also the passenger transport by road. So we see all those measures within this pillar will try to help leveling the playing field between the traditional providers and this platform economy we are living in nowadays. And pillar 3, the single VAT registration. This is basically good news for business operators because the main objective here is to reduce the administrative burden for those companies that are trading across borders and well, the aim is to reduce in the end the number of VAT registrations held in different member states. Any ideas, Matt, that you want to share on this slide?
Well, no, is that just to kind of emphasize this, just the fundamental changes that this is making to lots of different businesses, no matter what they're in. And although it's a digital focused, its impacts involves the supply of goods, the B2B supply of goods, the transfer of own goods. So there's lots of impact felt at different parts of anywhere in the EU market, really. So I think that's, there's some big changes in here, that's for sure.
Yeah, totally agree. Okay, so let's start with pillar 1, e-invoicing and digital reporting requirements. So upon approval of ViDA, that means already in place, we see that member states may implement e-invoicing mandates for B2B transactions at domestic level. So before ViDA, member states, you've probably heard of many of them, France, Poland, Romania, had to request the European Commission for authorization to implement the use of electronic invoices in B2B transactions. Nowadays, this will no longer be required because of some changes and amendments on the VAT directive in certain articles. They are now free to go to implement these e-invoicing mandates at the domestic level for B2B transactions. But the big changes from this pillar will come by 2030. We will see by this year a revised definition of the electronic invoice, of what an electronic invoice is. So it will refer only to structured electronic invoices that are that allow for automatic and electronic processing. So the e-invoice definition will, in the end, align with previous directive on public procurement, and basically with what we all understand that an electronic invoice is, right? Just this structured electronic format we can see in the slide, an approximation of it, and so it will get up to date, let's say, because nowadays it only refers to an invoice shared in any electronic format. So that's an important change as well. And in general, we will see how electronic invoices will become the standard across the EU. But probably the crucial amendments, the crucial change here is the implementation of electronic invoices for cross-border B2B transactions. So companies, as of this year, will have to issue and exchange electronic invoices for intra-community B2B transactions, intra-community supplies of goods, and intra-community supplies of services. They will have a timeline of 10 working days to issue these invoices. But the requirements do not stop here, meaning not only the directive will establish how businesses must issue the electronic invoices for these cross-border transactions, but since you already have all this invoice information in this XML or structured electronic format, which is so easy and fast to share, and also that systems are able to digest, the tax authorities will also want to know and that you share all this information with them. And that's why they are introducing what it's called the DRR, or the EU DRR, Digital Reporting Requirements, which is basically real-time reporting, transaction-based of these invoices for cross-border transactions. What do you need to know about this DRR? Well, suppliers making intra-community supplies will have to transmit the information immediately as soon as they issue the electronic invoice. And now they are also implementing an obligation on the recipient side. So those making intra-community acquisitions of goods will have to also report the specific information in this DRR, in this case within 5 working days. As a result, or as a consequence, there will be no longer ESL returns, or ESPL in the countries where we have ESPLs, meaning the recapitulative statements, European sales listings. This will be abolished because all this information will already be covered in this digital reporting requirement. And of course, in order to benefit from the intra-community exemption, it will be necessary to comply with these requirements of e-invoicing and digital reporting obligation. And lastly, since all member states will have to align the new digital reporting requirements they implement at domestic level for domestic transactions, the regulation makes an exception for those member states that have already these similar systems in place, such as Italy, France, Romania. So they have until 2035 to align with the EU digital reporting standard. I don't know, Matt, if you want to comment on this?
No, absolutely. No, it's a really good summary. So the things that really kind of jump out for me here, this, we call it, it's VAT in the digital age. And this is really, the reporting is going digital. Invoices are now becoming digital files that create, and contain, a lot of information, a lot of useful information, and that information is being shared in real time. So I think it's really shows the direction of travel as we go ahead in the next 5-10 years, that the information will be flowing much more quickly and much more available. So when nowadays, and what we've been doing for the last 20 plus years in my case, where you fill in VAT returns and tell the tax authorities what you've bought and sold and what you owe, is shifting from that to reconciling and reviewing to make sure what the tax authorities think you owe is accurate. So it's really a change of mindset from a compliance perspective, and from that preparation and submit to real time, what information is being reported, are my customers getting it right, are my suppliers getting it right? So there's a lot in this that needs to be considered, and I think that's possibly the biggest challenge now, is maintaining that and keeping up with that. And I'm sure there's people on this call who've been doing this a while and worked in the EU for a while. The fact that everything will conform to an EU standard doesn't mean there's going to be one approach. It means there's going to be certain standards that need to be met from an EU perspective, but we will certainly have different mandates, different regimes in different countries. So the way these things pan out, and the way the reports are required, and the way that all of these things isn't going to be uniform. So there's a lot to maintain and a lot to keep up with, and a lot of changes coming, especially now that the EU has changed it from if a member state wants to do e-invoicing, they need a permission, to now if they don't want to do it, they need permission. So everything's being put onto that side of the fence. So it really is a big fundamental change into how businesses interact with their customers and with the tax authorities themselves. And keep in mind that invoicing is a business process outside of tax. This is not just a tax consideration. Tax is driving this, but in fact, if you don't raise a proper invoice, you don't get paid. So there's a lot of different parts of your businesses that are affected by this kind of these kind of regimes. So yeah, that's what I think is the big stuff coming out of this Pillar 1.
Yeah, I totally agree. So don't know if you want to check if there are any questions or no questions so far.
Yes. So before we move on to Pillar 2, we do have one question. How will it work for Ukraine? It's not EU, so how can we use this system?
Well, yeah. I, as far as I know, Ukraine is not part of the territory unified for VAT purposes. So indeed, these updates in principle are not impacting them, unless there are some Ukrainian businesses, of course, that perform taxable transactions in member states. In that case, they will need to check which specific regulation and obligations they have to comply with.
Yeah, absolutely. And this goes into the point I was making about different systems in different countries. In some member states, they will expect non-established, so non-EU companies to comply with the rules, or at least some of the rules around e-invoicing, and in others, currently, they don't. But
yes,
once this becomes the normal, it's going to be hard to see how foreign companies won't be expected to, even if it's not a tax-driven thing, just their counterparts will be moving on to e-invoicing, and they will expect their suppliers and their customers to do the same. So even if it's not a Ukraine specific or Switzerland or so forth, even if these rules aren't your domestic rules, as you trade intra-EU, you will have to consider them in some cases.
Yes. Somebody had mentioned same for Switzerland, and I just heard you say Switzerland.
Yeah, no, I saw that pop up, so that's good. Yeah.
Perfect. Another question is an EI from SAP also e-invoicing?
Sorry, say that question again.
Is an EDI SAP or SAP also e-invoicing?
Alexia, do you want to take that one?
I'm not familiar with this EDI, but I would say that it really, the electronic invoice must conform to specific country rules, and that will depend on the specific country. So we have a European Union standard which establishes that this file in a structured electronic format may be used as syntax, which is UVL, CII. Then we have a specific implementation in real life, which is the people-based billing. But then we have country-specific formats based on the EU standard. So I would say you really need to check the country standards, the country requirements. I don't believe an accounting extract, even if it's in XML format, generally can be considered an electronic invoice. We really need to see, the specific requirements of the country, or even the industry.
Exactly that, and there will be certain standards and certain different data exchange processes, but in the end, that's it has to meet those requirements in order to be considered a true e-invoice. So not just an electronic document. There's certain digital requirements that make it an e-invoice or not.
Yes, I think this is the last one we're going to take specifically. Yeah, the rest we'll answer in the dedicated session at the end. This person wants to know, when you speak about 10-day deadline to issue an invoice, is this from date of receiving the deposits or after the service is provided or the goods were delivered?
It's a good question. So the regulation says since the chargeable event takes place, but we will need to check in case there's a prepayment and this type of things that could change things. Yeah, we will need to check.
But I would say that's similar to the current tax point rules around when you need to raise an invoice on paper versus an e-invoice, that those rules are still consistent. As far as I'm aware, I've not seen anything contrary to that. So you have to understand your tax points. And then when you raise an invoice, that could be the tax point unless you go over a certain number of days and things. So there's still all the VAT stuff that we love to analyze still happening behind all this. It doesn't change that.
Yeah, totally.
Yes. I do see other questions coming in, but I think we should move on to pillar 2. I have made a note of them, so we will get to them at the end.
Okay, so we move to pillar 2. Okay. There you go. So platform economy. This pillar focuses on the accommodation sector as well as the transport of passengers by road, and particularly when these services are contracted through electronic platforms. Currently, many providers of online short-term accommodation rental and passenger transport services do not pay VAT. And this could be because the drivers or the person that is renting their own apartment, they may not have an obligation to register for VAT because they can benefit from the small and medium enterprises regime that may exist in their specific country, or just simply because they are unaware of their obligations. So the objective here of the measures within this pillar is to level the playing field between the platforms and the traditional providers in these sectors. And how is this done? Well, by implementing the deemed supplier rule. In this case, platforms are made responsible and liable for collecting the VAT of the accommodation and transport services that are contracted through them. This is something similar to what happened back in 1st July 2021 with online marketplaces. So tax authorities, instead of dealing with many small businesses, what they really want is to deal with the big fish, let's say the big platforms that are facilitating the supply of this type of services. By when this will be live or effective? Well, we have a first voluntary phase starting July 2028 and a general and mandatory phase starting January 2030. Are there any exceptions to the deemed supplier rule? Well, yes. In this case, if the underlying supplier, so that driver or the person that is offering the accommodation services, if they provide a VAT number to the platform plus a declaration that they will handle the VAT, then the platform will be released from the obligation to be the deemed supplier in these transactions. I don't know, Matt, if you want to mention something on this.
And my first point is I would have put this as pillar 3 rather than pillar 2 because it kind of sits in between the other two, but then I was not consulted on this. But the key thing, I mean, this really is about the platforms themselves. They are, by becoming the deemed supplier, they will be liable for staggering number of transactions that have VAT on them. And you can totally understand the leveling of the playing field, hotels always charging VAT versus Airbnb type arrangements where there's no VAT. That's so this is there to kind of balance that out, and that makes sense. But for me, what really strikes me here is the amount of data that's going to need to be collected by the platforms in order to complete their responsibilities on this, but also how they're dealing with thousands and thousands and thousands of small suppliers, verifying they're VAT registered, verifying that they're going to pay the VAT. All of these implications are massive amounts of work and massive amounts of data. But I think for the purpose of this, it's those platforms that are going to have to bear the brunt of that compliance and that sort of data collection. But so yeah, I think as more platforms come online, because that's the nature of the world we're in, this will become more normal way of it. And it's very much, VAT in the digital age. This is it. Platform economy is now huge. There's no question about it. Some of the biggest companies in the world are platforms. So it's definitely here to stay in that respect.
Yeah, totally. Do we have any questions on this pillar?
Yes.
Okay.
Is there any, yeah, I'm not sure if there's any specific to this pillar. Just for that previous question, when I asked you, is an EDI from SAP also invoicing? She just said there's no electronic direct invoicing. She was asking, is an electronic direct invoicing from SAP also considered e-invoicing?
If it meets the criteria of an e-invoice, I mean, I'd have to dig into that one specifically. But
Yes.
the answer is, if it meets the criteria of an e-invoice, then it counts. It's all about how it's configured and what's contained within it. I wouldn't assume that if you've already got an EDI set up in SAP, then it is automatically an e-invoice that kind of qualify across the board in every jurisdiction. The chances are it won't. So you really need to drill down into what is the content of that invoice and does it comply with the rules in France, in Belgium, in Germany, and Spain.
Yeah. We must also differentiate the voluntary use of an electronic invoice, where you need to kind of agree with your business partner the way or the format that you can exchange, and then when there is a mandate that sets certain conditions on how you need to issue that invoice or which standards needs to comply with. Countries have specifications, like the Spanish specification based on the European standard, and so on. But as you can imagine, we are more tax people here, I think, rather than technical people. So yeah.
There was just one question which I think was relating to Pillar 1. How about between EU and England? By what time e-invoicing will be mandatory?
Between the EU and the UK?
And England, yes.
Well, again, I don't think that will happen. I mean, the UK has started consultations on implementing e-invoicing, but that will probably be linked to transactions that are taxable in the UK. So obviously, if you are an EU business and you are trading in the UK, you may be subject to this obligation, but it will stay at a domestic level transactions in the UK. I don't see a cross-border such as it happens in the EU, that for cross-border transactions they have already implemented this e-invoicing mandate for a future date, 2030. But I don't see the same happening in EU, UK.
No. The ViDA rules are very much intra-EU focused, cross-border, inter-EU states. But yes, you're absolutely right. The UK is looking at e-invoicing. It's got a roadmap for e-invoicing, and realistically, the UK, despite its best efforts, is very much aligned to the EU and will no doubt have an e-invoicing mandate that is fairly consistent, I would expect.
Yeah.
And again, it comes down to the more commercial aspects of, once everyone's using e-invoicing, how are these third countries like the UK and Switzerland, Ukraine, and further afield, how will they interact with the companies who have moved on to e-invoicing? That's a big question, I think.
Yes, that's true. When e-invoicing becomes the standard, we will see more and more pressure also from business partners to exchange electronic invoices.
Absolutely,
probably.
And it won't be driven by tax and VAT. It'll be driven by accounts payable and accounts receivable processes.
Yeah, totally.
Okay. So there's just another one. If the invoice submitted needs to be amended, can you amend it? Can you amend this?
Yes. Well, sorry, that's a bit flippant, but so yes, there is a process for cancelling, for reissuing, raising credit notes. There's nothing in the e-invoicing process that is so rigid it cannot be corrected, if I put it that way. But it won't be the same. There'll be a new process for doing it, depending on the country, because you've got interactions with the tax authorities, so there has to be ways of doing that. But absolutely, there will be flexibility to correct an invoice if the invoice is incorrect.
Yeah. Again, if we think of e-invoicing mandates, every country has their own rules, especially when there is a centralized model, so invoices are issued through a public platform, or when there's a real-time reporting, so we need to check country rules, but obviously there is always a correction method or mechanism.
Yeah. And I'll just amplify that bit. The central model that Alexia just described is where you send an invoice to your customer through the tax authorities. You send it to the tax authorities, and then your customer obtains it from the tax authorities. They are in that chain for invoices, and that is how connected to your data and your transactions the tax authorities will be. They will actually receive your invoice from your supplier before you do. And that's a mindset that people need to change, when in fact they're finding out the errors from the tax authorities rather than from themselves. So that's very much a mindset change around the reconciliation point.
Yeah.
Perfect. Happy for you to move to pillar 3 as well. Quick.
Okay.
Save it for the.
Yeah.
Yeah.
Good. Okay, so we move to the last pillar, pillar 3, single VAT registration. So probably I see you are concerned with pillar 1, and that's normal. You were probably thinking on all these new obligations you will need to adapt to, e-invoicing, real-time reporting, and so on. But pillar 3 will probably sound more like music to your ears, because the main objective of this pillar is to make businesses' lives easier, single VAT registration, reducing the formalities in the end. And we will see 3 measures that have this goal and that have been implemented with this goal in mind. The first of them is the expansion of the one-stop shop, the OSS regime, to other B2C supplies. So basically, the OSS will be available to report domestic B2C supplies of goods that are made by taxable persons not established in the member state where the goods are delivered. This
So
OSS,
Alexia, sorry, I want to just emphasize that point. It's domestic, it's kind of foreign domestic. So currently OSS is just for intra-EU B2C, whereas if you're doing domestic in another country, that's a VAT registration essentially. Now you can do domestic supplies in more than one jurisdiction through one OSS registration, and that's a significant change.
Yeah, it will have really a huge impact for many traders, not only e-commerce. As you can see, it will include also supplies of electricity and natural gas, supply and installation contracts, supplies on board of ships, aircrafts, and trains. And for those not so familiar with the one-stop shop regimes, these are a scheme that allows businesses to report the VAT that has been collected from multiple countries. And currently, as Matt said, it only works for intra-community distance sales of goods. So it's focused more on the e-commerce sectors, on those supplies of goods where the goods have been transported from one member state to another, and in B2C transactions only. So basically, we are thinking on online trade. However, this extension for B2C supplies of goods in general made by just foreign traders will make a huge difference and will have a huge impact. I don't know, Matt, if you want to say something else on this first measure.
No, well, not so much, but it just shows that the OSS is now is not a just sort of convenient for small trader, avoiding the need for someone to have to. It is the standard now, and even if you look at like electricity and natural gas supplies, with thousands of transactions. So it is very much a sign of where conceptually where the EU is going with that single VAT registration. You can do your compliance across the whole of the EU through one VAT return. It's very much taking that idea and moving it further and further into a standard normal process. And I think that's again is the sign of where we're going. It's a direction of travel more than a sort of a finished version of it. I think it's a direction of travel.
Yeah, indeed. In terms
I'm
of,
gonna
I'm sorry, Daniela, go ahead.
No, I was just going to step in for a question, but you can carry on explaining.
Just the effective dates I didn't mention. So there's an early availability of this expansion of the OSS for B2C supplies of energy products in general, so electricity, natural gas, etc., by 1st of January 2027. And then for all the other B2C transactions, it will be available by 1st of July 2028. And this deadline, 1st of July 2028, will also be the effective deadline for the other two measures we will discuss in a minute. But Daniela, go ahead if you want with the question. Yeah.
This question is relating to OSS. So when will OSS be required for B2B?
For B2B, so far, no news on that, but we will discuss a measure that will impact B2B, and that is also conceived to reduce the number of VAT registrations abroad when performing B2B transactions. So no OSS for B2B, but there will be simplifications tackling also businesses trading B2B abroad.
Yeah. Oh, well, I think there's one exception to what you just said, but I think you're just about to tell us about that anyway.
Yeah. Okay. So second measure we wanted to point out is the also huge change, and we have a lot of impact on many businesses trading in member states, is the expansion of the one-stop shop for movements of own goods. This is kind of a B2B, let's say, because at the moment,
that's the point I was making, because this is a kind of B2B, even though it's between the same company.
Yeah, that's it. So at the moment, businesses moving their own stock between member states. Imagine from member state 1 to member state 2, you move your own goods as a company. At the moment, you are performing a deemed intracommunity supply in the country of dispatch and a deemed intracommunity acquisition in the country of arrival of the goods, meaning that you need VAT registration in both countries to report this correctly. Once the one-stop shop for movement of own goods it's alive, it's working, we will see a reduction on the number of VAT registrations simply for moving a stock, because this will not be required anymore, and the movement will be reported through this OSS. So from a VAT perspective, there will be a deemed intracommunity supply taking place, and intracommunity acquisition that will be considered as VAT exempt, without registration obligation and without restriction on your ability to deduct input VAT in your general business life. An important remark here is that these OSS for movement of own goods will only be available for those businesses that have a full right of deduction of VAT. Otherwise, you will need to register in country of arrival and pay the corresponding VAT for the intracommunity acquisition. So just a note there.
Yeah, I mean, for me, this from a VAT perspective, I find this rather unsatisfying, because that's, for years we've been helping clients and dealing with clients. Movement of goods, you follow the goods. That's your number one rule when considering VAT. You follow the goods. So this is a real change where that movement of goods and holding stock in other countries, that arrival doesn't trigger a VAT registration. So that for me, that's a big change, certainly for what is a big part of EU trade is the manufacture and distribution of goods across the EU. This is a big impact one. But I suppose the thing that on the surface from this slide, what kind of bothers me a bit is companies are now holding stock in different member states. Okay, there's no VAT on the arrival, there's no acquisition tax, but as soon as there's an order placed on those goods and they're selling, they're essentially making a domestic supply in that country, which is a taxable transaction. So that for me leaves a bit of a gap on this. So actually, I don't know if you've got a counter to that particular point.
Yeah, it's true.
How about that?
So stepping in for another few questions. So when you talk, I don't know if this is relating directly to this one, but when you talk about reporting of IC acquisition, is it from the date of receiving of an invoice or the day of invoices booked in books of accounts?
Oh, yeah.
In terms of when the tax, as of now, under the new rules, it's essentially deemed to be VAT exempt and not reportable. In the normal sense, not reportable. You don't put it through a VAT return. But the tax point rules will still be the same. So it's the date they're delivered or the date the invoice is raised, depending on the gap between the two, would be my sort of first answer.
Yeah, probably this was referred to the 5 days, right, to report in the DRR for intra-community acquisitions. Well, as much as I can remember from legislation, it said 5 days from receiving the invoice. So supplier had 10 days to issue the invoice. The customer will have 5 days to report it from the receiving date. At least as much as I remember from legislation, yeah.
Okay, perfect. If we haven't answered your question, and you feel that you'd like a bit more context, feel free to just add to your question in the Q&A section. I am looking at them, so I will try my best to give it over to Alexia and Matt to answer your questions to the best of our abilities. The next question is OSS. Do we speak the same as MOSS? Is that going to be extended to other types of services or goods?
Okay, the mini one-stop shop. So that as of 1st July 2021, the mini one-stop shop was absorbed, what we know today as the Union OSS and the non-Union OSS. So that's for services. And for services, there's not much of a change. So basically, when we talk about B2C services that are taxable where the final customer is established, then you will continue to use the OSS as normal. So yeah, in the past we talked about the most, what we see now is an expansion of the OSS for goods, for supplies of goods, B2C. Basically, instead of only allowing reporting in OSS intra-community distance sales of goods, now we will see the OSS will be expanded for all B2C supplies of goods when they are taxable in a country where the supplier is not established. So even if we talk about domestic B2C supplies, we will see OSS will be available as well for those transactions.
Absolutely.
Perfect. So Lorenzo would like to know how this scheme might affect the provision of electronic services, i.e., server hosting and cloud services that already reports EU VAT collected under OSS.
Well, in principle, no impact at all. It's what we just mentioned. It will continue to work normally. The OSS for services, for B2C services, will continue to be available. The main update here concerns the supplies of goods B2C. Yeah.
Perfect. The last one that I'm going to take now, well, when will TOOG OSS will take effect?
Yeah, this will take effect as of 1st July 2028. So that's the date that is in principle foreseen in the regulation approved. Yeah.
Okay, perfect. I'm going to leave the rest of the questions. We can move on.
Okay.
I'm going to leave the rest for the next round.
Okay. Only a third measure that we are missing here. So all these 3 measures together, we see they work towards single VAT registration, meaning less VAT registrations abroad in different member states by foreign suppliers. In this case, it concerns the reverse charge mechanism. So there will be an harmonization of the reverse charge mechanism for B2B domestic transactions when these are performed by non-established suppliers. As probably many of you know, current Article 194 of the directive establishes that member states may implement a reverse charge in this scenario, in this type of supplies, when it's a B2B supply, domestic, and made by a non-established supplier. What happens is that since this is an optional clause for member states, we see that some of them have implemented it, some of them have not, some of them only for goods, some only for services, so we see no harmonization. What this measure wants to do is harmonize, and that all member states have available a reverse charge mechanism when a certain minimum conditions are met. And these conditions are the ones you can see in the slide. From the supplier perspective, it must be a supplier not established and not VAT registered in the country of supply, and the customer must have a VAT number. So those are the minimum conditions for all member states to implement this reverse charge. So it will be available in all member states, and both for supplies of goods and supplies of services. An important and separate note is that the amended directive will also allow member states to implement this reverse charge even if the customer is not VAT registered, does not have a VAT number in that country of supply. What means in practice that the customer will become liable to pay that VAT, and if it's not VAT registered, to get VAT registered for this purchase of goods. And as already mentioned, this measure also will be live in principle by 1st of July 2028. Any ideas, Matt?
Yeah, this is for me. This is quite. I find this one fascinating for a few reasons. So the good news here is that when you're a non-resident trader trading in different countries, then you don't need to get a VAT number in principle. So similar to the point I just made earlier around OSS and movement of own goods, you can now hold stock in a different country to where you're established, and then you can fulfill orders in that country without the need to VAT register. So I think there was a question there by Alice, keep the VAT registration for the onward supply, where in fact the onward supply will by default be a reverse charge transaction. So you can essentially have stock in multiple member states and be selling in multiple member states and not need additional VAT registrations. You've got your OSS for the movement of own goods, and then it's a reverse charge to the final customer there. So that's good. What I would say is the kind of the hard bit or the negative bit, I'll do the little one first, that idea that member states might insist the customer registers even if they're non-established, to me seems like a recipe for disaster, like a trade show or something who got 1,000 registrations. So I see some real sort of challenges around that one. But the biggest one for me is the place of supply rules still apply. So if you're buying in this country and then selling in this country, so you're basically trading, your purchases will still be subject to local VAT if they're from a established business, but you'll have no VAT on your output. So in principle, what you're going to be doing is running up huge VAT credits in order to simply make that supply. So if you're going to your head of tax and you say, good news, we can eliminate 7, 8, 9, 12 VAT registrations, so our compliance obligations and costs are going down. However, when you go to the CFO and say, we're now going to be looking at input VAT credits across all of these markets, that might not be such good news. So I think that what will be eliminated is, for example, a quarterly VAT return, but in its place will be a quarterly VAT claim, and in order to keep that going. So I can see companies looking for ways to get around this in order to maintain a positive cash flow rather than to maintain just to kind of benefit from the rules. So that's my biggest sort of thought on this one. I can see the simplification, but from a business perspective and a cash perspective, this doesn't necessarily feel too exciting for lots of companies, I suspect.